Bismillahirrahmanirrahim. Okay, before we start, so I want to remind for the all of you before dissertation defense start. So please set your mobile phone into silent mode, and it's not allowed to take picture or photo during the dissertation defense, except that already had permission from SPS ITB, since it will disturb its process. Okay, Bismillahirrahmanirrahim. Ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. Greeting for all of us with Bismillahirrahmanirrahim. I declare this dissertation defense a start. This dissertation defense is held to give opportunity to candidate doktor Saudara Nanang Rosidin to promovendus Nanang Rosidin to deliver her dissertation research. The title, Structural Analysis of Index Fund Investment Model, Application of Mixed Methods for Analysis of Index Fund Flow and Performance, Index Fund Flow and Performance. And opportunity also for the candidate, for the promovendus to answer questions or defend his or her dissertation against critics and comment in this session. Candidate doctor has been doing her research under supervision of a team of promoters as follows: Professor Dr. Insinyur Sudarso Kadri Wiryono DEA from ITB as chief promoter, and then Oktova Yuda Sudrajat ST MSM PhD from ITB as chief promoter, while the examiners in this session are Professor Donald Lantu ST MBA PhD from ITB, Dr. Insinyur Subiakto MBA from ITB, and Dr. Agus Sugiarto from OJK. Ladies and gentlemen, next I will ask the Chief Promoter, Professor Dr. Insinyur Sudarso Kadri Wiryono DEA, to deliver curriculum vitae of candidate doctor, doctoral candidates, and then to convey academic accountability regarding to the acceptance of this dissertation. So please, Pak Darso.
Thank you, Prof. Utomo, as a chairman in this seminar. Nanang Rosidin graduated Bachelor of Engineering in Mechanical Engineering, Faculty of Industrial Technology, Bandung Institute of Technology, and then continued his Master Studies and graduated Master of Science in Development Studies, School of Architecture, Planning and Policy Development, and ITB also. His working experience is Nanang experience and skill in problem solving, with a comprehensive technical background and expertise in all phases of project management, including field studies, detailed design and construction management, with extensive knowledge of project cost estimation, facility operation and maintenance, business processes, and investment analysis. His work experiences as an engineer was mostly done abroad, including as the project engineer as Research Park Facilities Development at King Abdullah University of Science and Technology from 2013 and to 2015, as a facilities engineer at Campus and Technology Park Services of King Abdullah University of Science and Technology also, and as a project design lead as engineering and project management in the same place, King Abdullah University, and lastly as a engineering lead for planning, design and engineering construction at King Abdullah University of Science and Technology from 2021 until now, present. Academic accountability for the dissertation draft, Dr. Promovendus Nanang Rosidin, with the student ID 390-22008, with the dissertation title Structural Analysis of Index Fund Investment Model, the application of mixed method for analysis index fund flow and performance. The brief description of his dissertation. Nanang's dissertation research was motivated by the rapid growth of index mutual fund and ETF in Indonesia, with an average increase of 42% in the period 2015 to 2020, reaching a value of 15.9 trillion rupiah at the end of this period. However, although index funds are considered as a long-term investment instrument, almost one-third of index funds have not survived in the last 8 years. Although some index funds invest in assets with the same comparative index, the performance and cash flow received by each of these funds are different. The differences in performance and sustainability of index funds are related to internal and external factors that are interconnected in a complex system. The existing literature does not fully explain the complex structure and dynamic nature of index funds. This research aims to fill this gap by modeling the structure that affect the performance and cash flow of index funds. Nanang Rosidin dissertation research at SBM is under the Business Risk and Finance (BRF) expertise group. His research methodology, the proposed study of Nanang used a simulation approach that employs system thinking and dynamic to provide a more holistic understanding of the dynamic of index fund investment model over time. This approach could help fill the methodology gap in the literature and contribute to a more thorough understanding of the factors that drive index fund performance and flows, which is critical for investors and fund managers seeking to make informed investment decisions. This framework incorporates interdependent causal relationship between variables within the fund's management process, for example, fee setting, marketing expenses, cash liquidity, index tracking strategies, trading costs, security lending program, compliance procedures, and shareholders account policies, and so on and so forth, and variables related to the investor decision-making process. This study also seeks to provide a more comprehensive and nuanced understanding of the industry dynamic by employing system dynamic method in analyzing fund performance and flow in the index fund industry. About the contribution of this study, the contribution of Nanang research dissertation study are manifold. Firstly, the study enriched the literature by providing a new framework based on system thinking and system dynamic approach, considering that fund flows and investor decisions are dynamic and change over time. This framework integrates the interdependent causal relationship between variables in the mutual funds management process and variables related to the investor decision-making process. Secondly, the simulation conducted helped provide a more holistic approach to understanding the phenomenon while enabling scenario analysis for policy or strategic intervention that can attract the attention of investment managers and investors who want to increase their investment return. And thirdly, the generative capability of the structural analysis approach allows its application to other investment management domains, such as hedge fund management, resulting in more contextual solution. The publication that have been produced regarding the dissertation research. One paper in journal Scopus first quartile first under and 2 articles published in journal Scopus quartile 2 and 1 article published journal in Scopus quartile 3 and 2 articles in international conference proceedings. Thank you, Mr. Chairman, and all the audience for the attention.
Okay, thank you very much, Mr. Chief Promoter. And now I will ask the candidate, doctoral candidate, to attend to this session, please. Okay. Yeah. Okay. Okay. So, candidate doctor, doctoral candidates, are you healthy enough to perform this dissertation defense?
Yes, inshallah.
Okay, doctoral candidate, you are given opportunity to present your dissertation research in maximum 20 minutes. So, time yours, please.
Okay. Yeah. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh. Our esteemed professor, doctor, and also invitee to this doctoral defense. Thank you very much for the opportunity. I'm grateful for this opportunity, and I would like to deliver the research about the structural analysis of index fund investment model associated with the analysis of fund flow and performance. I would like to start with the terminology and assumption, just to align, because we have one feedback from our examiner, Dr. Agus Sugiarto, that what we are talking in our research is about the mutual fund. The mutual fund is managed collective investment scheme that pool asset from many investors to buy securities. According to OJK, or Financial Services Authority, there are many categorization. There are 9 categorization of mutual fund. However, in our case, we are interested on the 3 mutual fund, which is equity fund, index fund, and ETF. Following the theory by Petri in 2021, we categorize equity fund as actively managed, and the index fund and ETF is passively managed. So in this case, the passively managed is delegating the investment decision to the index provider. We saw the phenomenon globally, and this is the data from the US, that there is shifting. It seems like there is a shifting in investment preference. We can see that out of the 25.5 trillion US dollar, 52% are held in the long-term asset. And as we can see from the graph, there are positive inflow to the passively managed fund for around 2.6 trillion, and associated with also the same amount, which is 2.5 trillion US dollar, outflow from the equity fund. However, the asset portion in the long-term fund is increasing from 10% only in 2010 into 52% in 2023. What interesting as well is almost 95% of those assets are held by household investors. We look into Indonesian data. In Indonesia, the ETF and index fund also receive an increased inflow. We can see that in 2013 it's only 2.8 trillion in net asset value, but in 2024 reached to 26.59 trillion, which is around 23% capital compounded annual growth rate. However, in Indonesia, it's only 5% of the total mutual fund. We look into the data from OJK that time, that what's interested for us as well, that the lifetime of those index fund is very short. If we are looking into a long-term investment vehicle, there are very limited number of index fund that is more than 5 years. There are new entrants around 2018. However, around 1/3 of them are either struggle or get liquidated. Why we see that shifting household saving to mutual fund is beneficial? First of all, we see the potential If we can see from the graph, the green color is representing the third-party deposit, DPK in Indonesia. Comparison to the mutual fund asset is decreasing. Until 2022 is only around 6%. While we know that shifting to the mutual fund might offer a household income a better return. We can also, especially for the index fund, it's offer reduced risk compared to the individual stock, which is more volatile. We saw the data in the World Bank. The World Bank always report the metrics, which is the mutual fund asset to GDP. Indonesia currently in the region of 3.72, that's the ratio. And if we look into the data of Singapore, it's very big, almost 300 times of that. So if we are talking about GDP, all those kind of things from the investment, this could also play a role. Research question, so we looking into this phenomena, we are interested to understand what is the performance of the index fund in Indonesia. However, before we go there, we would like to understand what is the actively managed equity fund performance. Is it because the equity fund performance is very good, why people is not shifting to index fund? Or is it because of something else? So we start with this question, looking into the equity fund. Number two is we would like to understand what are the factors affecting index fund performance. From this graph, even though we have two index funds following the same index, which is LQ45, one index fund is outperformed, the other index fund is underperformed. So what are the causes of that? We believe that it could be because of the causal structure associated with that, so we would like to examine that. Number four is influence of cash allocation, so basically number four, then number five is associated what are the strategies that fund manager could do in order to enhance the performance of index fund. And the last one is associated with the cost, because in the world right now, the index fund is offer very low cost. However, in Indonesia, it's still higher cost. So what could be a new structure that can be adopted in Indonesia to allow for that lower cost? We look into the current research until 2022, when we did the literature review, there are around 3,500 articles. We use the string, we follow the Prisma metrics, 3 by 3 by 3, using all these keywords, and we end up with around 3,500. Looking into that, there are new departure of the research, which is mostly related to the personal investment, and also new theory. There is a new theory, which is adaptive market hypothesis, in comparison to efficient market hypothesis and behavioral science. And we look into the performance and equity fund, still the area that is heavily researched. We narrow down those 3,500 reducing the redundancy, reducing the not related to our research, all those kind of things. We end up with around 37 articles. We map all those 37 articles here. And as we can see, there are new departure, like new leverage technology for the fund using the AI. There are issues with the common ownership. There are issues with the corporate governance, all those kind of things. However, since our focus is on the survivability and flow, we limit our research to fund performance and flow. Reading into this literature is a heavy task, especially if we don't have a structure to categorize those literature. So we use these metrics to easily identify where are the areas of those literature. So in order to evaluate the topic of the performance and fund flow, what are the factors associated to it? And as we can see here, out of so many articles listed here, most of the approach is looking into the factor that affecting fund flow and performance independently or separately. So this is like people building a room. However, our approach is, why can't we look into it as an integrative approach? Because those factors are inherently within the index fund and affecting the performance of index fund. So we combine all those into a single model. To answer the first question about the actively managed fund portfolio return, there are a solid theory actually about that average equity fund return is lower than the market return. However, we have a very good opportunity at this time when the stock market implementing the asymmetric price limit policy, which kept the limit of the downside of the risk and the upside of the risk not symmetry. So by doing that, I have a hypothesis, maybe in this situation, equity fund manager could use it as a leverage to increase the return. So, however, by doing this, we use two models, market model and capital asset pricing model. We see from the panel regression that the average performance of equity fund has improved. So before the policy and after the policy, it has improved. However, the alpha, or the intercept in this case, still in the negative territory. But in this case, less negative after the implementation. Sorry. Okay. The next one, we analyze the abnormal return of the equity portfolios. Using the event study, we analyze for each window. So we use March as the window 0, P0, and then 20 months from there, we count and we calculate the average abnormal return of equity fund. So we see that the average actual return is fluctuate, but the cumulative is increasing. Okay. There are different behavior of each model. We see that the constant mean model, which is the average return of those equity fund, is more sensitive compared to the market model or capital asset pricing model. It seems we did a significant test. We would like to understand if this data is significant according to statistics. We use two approaches, which is the parametric and non-parametric test. This bar on the graph here is usually represented as asterisk to indicate the significance level. Okay. So the 3-bar graph is 3 asterisk, which is significant by less than 0.01, and 1 bar, which is 1 asterisk, less than 0.1 significance. As we can see here, those tests indicate that our result, our number is significant. And the constant mean model in this case reporting more significant windows compared to other, which is in our case, maybe this is more suitable for to be used as a model. Another discussion in the review of performance of equity fund is about the alpha, beta, and also the value added. I think the new theory is about the value added, because they said that there is this economies of scale. The alpha could be lower when the NAV goes higher. Okay. So in order to do that, we did the evaluation as well on the value added delivered by the equity fund. We use this sample for the period of 1 year, 3 years, 5 years, and 10 years. And as we can see here, the dot in representing the value added for each month, which is fluctuate, sometimes able to deliver value added, sometimes we're not able to deliver value added. However, in cumulative, surprisingly for us, groups of equity fund deliver negative value added instead of positive value added. We ran the test about this economic of scale to see the relation between alpha and the value added. We found something unique for the emerging market that in our case, from the data that we have, the alpha have a positive correlation with the value added, even though the number is very small. So we look into the literature, and the literature also found similar case for the emerging market, like in the Pakistan, or the index fund in US that investing in the emerging market. We then continue with checking if the alpha can be a predictor for value added. This is when alpha can be predictor for value added. We see the same. The difference with the market model is we select an investable asset. In this case, we select a certain traditional index fund, and we select also a traditional ETF as a benchmark. And compared to this, alpha can be used as a predictor for value added. So we strengthen the literature that based on our empirical finding, alpha and value added can be used as complementary to each other to evaluate the performance of equity fund. Next, into the model. So as highlighted in the SOTA matrix before, that we see that those variables are interrelated and interconnecting to each other. The basic of the investment model is the index fund asset, which is NAV in this case, is affected by the inflow and outflow, and inflow and outflow are affected by endogenous factor and exogenous factor. So using the causal loop diagram, we see there is a feedback. There are lots of feedback between those variables. As we can see that the asset has a balancing loop with the cost, return has a reinforcing loop to asset, redemption has balancing loop to the asset, and so on. And then we also see what is it related to the capital asset pricing model. We expand further the model that the asset of the equity fund at the minimum comprise into two. The first one is the cash or cash equivalent. The second one is the securities, portfolio securities. And every variable is affecting any of these separately. Redemption is affecting the cost, but the portfolio gain or loss is affecting the security. Dividend or distribution gain distribution is affecting the cash. However, buy and sell is affecting the portfolio securities. By doing this segregation, we can model later, and we can simulate what will be the impact of the cash decision, any decision the fund manager use in managing the cash or managing the portfolio. Cost associated to cost. So the cost of index fund, I think this is, I got influenced by Jack Bogle when he said the cost matter hypothesis. He said that cost is very big in the equity fund. So we look into this as well and look into that the cost that was reporting in the fact sheet of index of equity fund, not necessarily all the costs. There are other costs that bear by the investor. So this is the area where we can work on how to reduce the cost. These are the system intervention, the policy that can be done to enhance the system. We run it and we have more detail in our thesis. This is the behavior replication. So the model, after we run the model, the simulation, we are happy to report that there is a good fit between the model and the reference price. So the first one here, the small one, is the model. The second one is the price of index fund as reported by the fund manager. And the third one is the price of the index, reference index. Yes, there is less. At the beginning, it's almost the same. However, at the end, because of the time, it gets wider. However, the good fit of the model is 0.86 in R square. Is very good. Even we evaluate the mean absolute error and mid absolute percent error, which is in the accepted areas. One of the things that we are interesting to see as well is the agent and principal alignment in terms of the cost. This is what we learned from international regulation and practice, that the index fund cost in Indonesia is still very high, which is 1.57 to 2.13 of the AUM. While in the US, it could be 0.12% or even 0.4%. Why they can manage to do that? So the way we see is there is a conflict between agent and principal, that the fund manager is responsible to the company, to the shareholder of the company, to maximize the value of the company by getting the profit out of that. However, there is a structure that possible that the profit that come from this management of the index fund could come back to the investor, either in the form of increased net asset value or reduced cost. So we simulate this structure and we see that this is possible to enhance the index fund cost even further. So in conclusion, in average, stock portfolios fail to deliver positive alpha and value added, even during asymmetric price limit policy. Yeah. This is one of the novelty that we put in our papers. Investor could consider investing in the asset that provide market return. And there are factors that associated with the index fund performance, and we see that this factor cannot be seen as independent. It has to be seen as integral. There are interrelated and interdependence in between them. There are complex system and also dynamics. And there are strategic intervention that could reduce the cost. There are also a structure that can be used to reduce the cost even more, and solving two cases. Deliver a much better return to the investor, and number two, solving the agent and principal issues in the index fund. These are the output of our research. We have 4 papers published, 2 of them in Q2 journal, and then, sorry, this was wrong. This one was typo. 2 manuscripts right now is in the Q1 journal under review, and we attended 3 conferences as well. So I acknowledge for everyone support during our research. I really appreciate all the feedback, all the support, because that's what I learned from all this process until I come to this place right now. Thank you very much.
Okay, so the total time is quite on time, yeah? For 40, 20, 19 minutes. Okay, yeah. Okay, so let's continue. Next, we start the discussion, question, answer. So, ladies and gentlemen, this session is continue with questions and comments. Do you want to drink first?
I'm okay. Thank you very much.
Okay? Okay. Yeah. So first, I would like to ask the external examiners, Dr. Agus Sugiarto from OJK, to deliver some questions and comment. So Pak Agus, you have maximum 20 minutes. So please, Pak Agus.
Thank you, Pak. First of all, I would like to say thank you very much for inviting me. Yang terhormat, promotor Profesor Dr. Insinyur Sudarso Kadriwiono, co-promotor Bapak Oktova Yuda Sudrajat, MSM PhD. Yang terhormat, Chairman dari Sidang Terbuka ini, Profesor Dr. Insinyur Utomo Sarjono Putro, Master Engineering. Yang saya juga hormati para examiner, Dr. Insinyur Subiakto Sukarno, Profesor Donald Christopher Lantu, dan juga saya sendiri. First of all, I would like to say congratulations to Bapak Nanang Rosidin.
Thank you, sir.
Your hard work. I appreciate your outstanding dissertation. I learned a lot from your dissertation also, Pak Nanang. I have 2 questions and 1 suggestion. I would like to deliver 1 suggestion first before I deliver 2 questions. My suggestion is that on your dissertation is perfect, good structure, good writing. However, I suggest you can use the latest survey from OJK on financial literacy. On your dissertation, you still adopt 2019 survey. We have the latest survey on 2024. The number is totally different. So maybe it can help you to revise the paper with the latest information. Yeah.
Thank you.
The question is that I love your proposition on endogenous and exogenous variables here as indicators to see the long-term performance of mutual fund. We believe that endogenous and exogenous variables interested in so many areas here. Like endogenous, how the fund manager manage the mutual funds, how the fund manager decide how much money they have to pay to the investor, how much the cost of operation, how much the cost of management fee, etc. On the other hand, because you imply agency theory model, exogenous variable, which is the investor, they see different thing. Like they will prefer to see market fluctuation, market price, market risk, and so on. One thing that we learn from mutual fund is that mutual fund is very important, very useful for first-time investor, for the first-timer. They learn how to invest in capital market easily because managed by somebody else. However, mutual fund has some limitation, such as the investor cannot control the performance. lack of asymmetric information, and so on. And the investor cannot be guaranteed that how much money, how much return they can have. The question I have to raise on this dissertation is that what is the most dominant variable influencing the long-term performance of mutual fund? You have decided that you have endogenous and exogenous variable. Between endogenous and exogenous, which one is the most dominant, the most important factor projected the long-term performance? Okay. That's my first question. The second additional question related to the first question is that, let's say, if you choose the endogenous or either the endogenous, between them, there are a lot of factors, like on endogenous, like cash management, operating cost, management fee, tax ratio, and so on. Between the variable, inside the variable, which one is the factor, dominant factor, who influence the variable? That's the first question. Okay, and do we have to have the first answer, or I have to carry on with the second question, Pak Utomo?
Yeah, please, Pak, one by one is okay, Pak.
Okay.
Thank you.
Okay, thank you very much, Dr. Agus Sugiarto. Thank you very much for the very good question. As highlighted earlier, so as highlighted earlier, that this is what highlighted by Dr. Agus, that if investor invest in the index fund, they might have not the decision or capabilities in terms of deciding which stock or which portfolio that they are choosing, because in this case is delegating to the index provider. This is one. Number two, they might not be able to capture the momentum as well. I think if you are talking about the Fama French CFEM 5-factor model, there are momentum that is already accounted there. An index fund might not be able to capture that. Let's say we have a tariff issues recently. When the market goes down, not easily to go out. When the market goes up, not easily to get in, okay, in terms of the index fund. I agree 100% on that. And I have mentioned all these limitation in terms of the index fund in the dissertation document. This is one. Number two, we still see the index fund is because the theory and the fact supporting that there are two cases where it is very hard to predict. First one is in the bull market, when the market goes up, some equity fund deliver a very good result. However, as Charles Iris mentioned, that the hard part is to identify them beforehand. So which fund is going to be able to deliver the highest result? Because this is the challenge. The problem is because the performance, the previous performance does not indicate the future performance. So the equity fund that was able to secure a good performance in the past does not necessarily will be able to deliver a good return in the future. So this is the case. This is one. Number two, when the market downturn is, yes, the momentum will not be able to capture. However, if we see in the long run, the trend of the fund, the stock market is going up. We have the case in 2008. We have the case in 2014. We have the case in 2020 during the COVID. We also have the case now during the tariff in 2024. And if we can see the market drop and then bounce back, for someone who stay within the market for that time, still gain the result. So as investor in general, it might be safe for them to stay with the index fund. Does it mean that they cannot invest by themselves or using the equity fund manager? For sure, no, because I think I have responded to the examiner comment as well about the about the issues with the about the issues with the fund. Okay, sorry, Mr. Agus. So, the second part is in the long run, the stock market is still trending up. Means the general as the general investor, they are safer to be with the market index. That's the case. And the second one, Dr. Agus, the second one is about what is the most factor affecting the performance of index fund. If we can see here, yes, there are factors, this is exogenous, like the portfolio gain or loss. This is beyond the manager control. If the market goes down, it can go down. However, there is something which is the cost and the cash. So one of the things that we found in our modeling is cash management is really affect the index fund performance. Because ideally, when the fund manager receive the fund, when someone when someone buy the index fund, that cash has to go to the security right away. So when someone buy the index fund today, the money that's available in the cash portion has to go directly to the portfolio securities. However, the fund manager has to retain a certain amount of cash because someone might redeem. This is an open fund, open type fund. So someone can redeem at any time. Someone can sell their ownership here and then get. So the way they manage how much cash they should keep in order to balance between maximizing the return on one side and keeping people who's redeeming the stock can be optimized. So this is the first one. So the first one is the cash and the second one is the cost. The more the fund manager able to reduce the cost, the best the performance, which is the tracking error between the fund to the comparable index is getting smaller. When it's getting smaller, the cost is cheaper, the cost is lower, the performance will be increased. That's the answer, Mr. Agus. Hopefully it's answered your question. Thank you.
Thank you, Mr. Nanang. So you see that the endogenous factor is more dominant compared to exogenous. This is your conclusion, yes?
Yes.
Because sometimes people say that exogenous is more dominant because you cannot beat the market. Exogenous is based on the market fluctuation, the market risk. You cannot predict how much the share will go up and will go down, and so different. I appreciate your argument, but my second question is that about the methodology. I love to see that you apply the event study methodology, because this event study methodology I already used when I did my PhD in Venice in 2000. The methodology of event study is very common and is very correct to measure the performance of any event, any event related to the performance. However, we see that event study methodology also has some limitation. Sometimes we cannot see the exact event influencing the performance. Let's say sometimes there are multiple events in the same day, in the same hour, in the same week, in the same month. We cannot see, we cannot detect which one is more dominant than the others. That's one limitation of the event study. I believe that the longer event study you apply, the longer there is probability bias. However, we can mitigate the bias. Now, I would like to imply the event study on your dissertation, Pak Nanang.
Yeah.
You write down that event study methodology, you apply 20-month event window every month, not every week.
Yeah.
Measurement based on week base and monthly base is totally different. The result is different. You imply 20 months event window from the month of March 2020, after the government released announcement that COVID-19 has arrived in Indonesia. At the time, the government of Indonesia released some policy, macro-prudential policy, monetary policy, micro-prudential policy to mitigate the effect of COVID-19. One of the micro policy is from OJK and also from Bursa Efek Indonesia in the stock exchange to reduce the volatility with one regulation. One of them is to reduce, to limit the rejection from 10% to 7%. Yeah, between March until 20 months later on, you starting from March as 0, April 2019, 2020 as T+1 until 20 months later on. It means more than 1 year. So approximately until September or August 21, yeah, 2021, yeah, Pak.
That's correct.
However, we see that the important event is not only the announcement of the COVID released by the government, but also there are some important events during T20, your event window. One of them is penemuan daripada vaksin COVID. Yeah. Vaksin COVID already has landed in Indonesia on 7 December 2020. And at that time, the index of harga saham gabungan Indonesia, IHSG, Indonesian Index of Capital Market, becoming 6,350. Comparing, 5,882. Comparing to 3,937 on 24th of March. So big jump. And on January, the index of IHSG also increasing because already injected to the community, the Sinovac vaccine. So the question is that, let's say, if you differentiate average abnormal return as well as cumulative average abnormal return from T1 to T9, for instance, when the vaccine landed, how much the total capital cumulative average abnormal return, and then after that. So we can have different part of measurement. It's okay with every 2 months measure, but you can, I think you need to differentiate when the vaccine is announcement for the first time from the American factory, British and also the Chinese, and when the people of Indonesia injected by the vaccine. So we can have a different result if we separate the cumulative average abnormal return based on those events. Thank you, Pak Nanang. This is my second question and the last. Thank you. Good luck.
Thank you very much, Dr. Agus. I really appreciate the question. So the event study we use is to evaluate the return of the equity fund, the return of the equity fund during asymmetric price limit policy. The price limit asymmetric policy itself span for around 36 months, more than 36 months, starting from March 2020 until September 2023. Yeah. If not mistaken, 2023 or 2024. 2023, I think. So it spanned a very long price asymmetric limit policy. Okay, this is one. Number two, I agree 100% that in order to evaluate a certain effect of a certain event to a portfolio, a lower windows might be helpful. However, the case that we are using here is long-term investment. So we are looking at comparability of the equity fund as a long-term investment to index fund as also long-term investment. So windows for us, especially for the mutual fund, which the reporting of net asset value is also takes some time. In order for people to buy and also for people to redeem, it also takes some time, usually within a week. So a 1 month period, and this is available in public as a public data, available from the OJK website. Really appreciate all the data that is there. This is become available public data. Monthly report of net asset value of mutual fund is accessible to everyone. So using this public data and evaluate for monthly less than the time of implementation of the price limit policy, asymmetric price limit policy, in our standing can still yield the result for evaluating the performance of the equity fund. Are they able to generate the average abnormal return? Are they able to generate cumulative average abnormal return? To goes into your point about, for sure there will be other policies or other events that impacting this. One of it is the finding of the cure for the COVID-19, for the vaccine. And then there is also other macroprudential from the Bank Indonesia, from the government, all those kind of things. That's why in our dissertation, we use the rolling window. So we calculate the average abnormal return every month, and we also do the rolling window for every month. So this is the first month, the first second month, the first third month, 3 months, the first fourth month, all the way until the total 20 months. And then we calculate also the total cumulative average abnormal return. So in answer to your question, Dr. Agus, thank you very much. Yes, it's clear for us that we might be able, and this could be a suggestion for the future research. I would like to look into this as well. I really appreciate. I would like to take this as a suggestion that maybe we can separate as a net if we have the impact of asymmetric price limit policy, and if we have the abnormal return associated with certain event, what will be the net effect of the price limit policy. However, in general, based on our data, including the panel regression analysis, the asymmetric price limit policy able to reach the goal, which is reduce the volatility and actually deliver a better return to the investor. However, as equity fund, as a group, it's still lower alpha, lower value added even, compared to the index fund. Thank you, Dr. Agus.
Thank you, Pak Nanang, is enough, and thank you for your excellent answer.
Thank you, sir. Really appreciate it. Thank you.
Thank you, Dr. Agus Sugiarto from OJK. So let's move on to the examiners. Number one is Professor Donald Christopher Lantu, STMBA PhD. Please.
Thank you, Mr. Chairman. Pak Nanang, first of all, congrats for your journey. Yeah, this is a very interesting study. Yeah, you have a novel conceptual framework using especially system dynamic based models. Yeah, to understand the complex causal structures, as well as you also have a quite holistic methodology combining the quantitative event studies, panel regressions using GFM based simulations. So yeah, this is the mixed method approach enables both precision and broad insight. Yeah. Okay. Firstly, I want to discuss about the methodology of system dynamics modeling. Is there any other alternative in quantitative model, for example, econometric model and machine learning that may support or challenge the findings that you already have?
Okay. Thank you very much, Professor Lantu. System dynamic approach we choose is because we believe that based on the SOTA matrix, factors that affecting the index fund performance usually seen as an independent factor and consider the rest as ceteris paribus. So what we do is we take all those factors in the same time. We see the interrelation and proceed. By doing this, we are able to maybe coin the first model, formal model of the index fund using a system dynamics, because we didn't see any model previously like this. We went to the international conference of the system dynamics as well, including we put it to the journal. There is the journal was published for this one, and international system dynamics we got a feedback as well. There is an interesting feedback in the international system dynamics is there is one officer in the 401k, which is pension system in the US system, and he said that this is the first time he understood the index fund from a structure point of view. Okay. So we were able to coin this as a formal model, because from the scientific point of view is everything has to be, I think we are following the Sir Karl Popper, that for a scientific things to be examined is there should be able to be reputation and falsification. So by bringing this into light right now, using this model, using a formal model, it's become available for falsification or reputation. So for sure there will be other models. I think big data could play a big role in this case to challenge or validate this model, if it is make sense or no, within the more granular data. What we have right now is monthly data. If someone was able to access the data from the fund manager using the daily data, and those data for sure will be a large data. That's why big data analytics could help in this. They could clarify or challenge this information, including the econometric for sure. I think the previous approach, what are in the literature right now, mostly from this econometric point of view, using the statistic, using regression. But with this, we coin a first model using the system dynamic that open or reputation or falsification, which is, it should enhance from the scientific point of view. This is a point for further enhancement, further discussion. Thank you, sir.
Very good. So you link with the Popper, about the scientific testing. Yeah. So I wonder about since this is heavy, powerfully driven by system dynamic modeling, yeah. How about the empirical testing beyond the theoretical calibrations?
Okay.
Yeah.
So for the empirical testing, we are doing two stages actually for the empirical testing. The first one is, maybe I have to, excuse me, I have to show. Oh, okay. So this is in the dissertation. We do the testing of two things. The first one is we clarify if the result. The second. Okay. So which is this one, the one that I presented already. We clarify if the result of the simulation can close to the actual data, which is the data from the fund manager. So, sorry, it's not shown. Okay. Okay. So this is the empirical test, basically to see if if our model are able to generate the behavior based on the data reported by the fund manager. Okay. So the second line, which is the one in, the second line, which is this one, the second line, the one in the middle is the one data that reported by the fund manager. And the other one is the price from the index. We test this to see if it is close enough to the data or no. And then we did a test of the good fit as well. That's why I reported before, we have a good fit of R square of 0.8, which is closer. The second test of the data is also on the error, tracking error. So we did the report on the tracking error if the model are able to validate the tracking error as reporting by the fund manager. So we see both this data is close and are able to also capture the market dynamics. If we see here, this is the area where we have, this is the area where we have the crash in 2020. So it's follow the pattern. This is also where we have the issues in 2014 or 2015 with the market. So that's how we test the simulation with the data. I hope it's answered your question, or if you have additional question.
Yes, this the data also based on the fund manager's point of view, right?
That's correct. So we got the fact sheet from the fund manager. We double check that fact sheet with the data from the Bareksa, because Bareksa has that data, and also data from the OJK. OJK has monthly data, Bareksa has more detailed data. So we use that data to validate this model.
Okay. How about the behavioral assumptions?
Behavioral assumption, you mean the investor behavioral assumption?
Yes.
Okay. So most of the approach we are using is the efficient market hypothesis, okay, which is assuming that the market is efficient, number two, and the investor are rational. Okay. This is the first approach. We understood that efficient market hypothesis is not perfect. There are behavioral science against this market hypothesis, but as it said that in the Immanuel Kant, that anomaly itself cannot just explain cannot just refute the theory. The theory has to be refuted by another theory. So anomaly in the event is not necessarily falsify a theory. It should be another theory, right? So there is another challenge to this AMH that is very close right now, which is AMH, adaptive market hypothesis. One of the supporter for the one who coined this term is professor from MIT, Andrew Lowe. I have his books as well. So he said that effective efficient market hypothesis is not wrong, but it's not complete. There is a case where a behavioral science kick in. There is a case where behavioral science kick in, where the investor behavior and the population dynamic or the environment of the market is also affecting or make people change from rational to irrational. That could lead to behavioral bias, that could lead to herding, all those kind of things. So we have the opportunity in this case, but most probably not in this research, it could be for the future research. Our model here shows that there is a feedback. This is also aligned with the prospect theory from Kahneman, that there is a reference point. For someone to do a decision, to make a decision, there is a reference point. So if the investor is going to either decide to buy acquisition or redeem the asset, there is a reference point. Their reference point is expected return. If they have the expected return at a certain point and the asset, which is the return, the actual return from the portfolio that they have, is within their expected return, most likely they will buy more. But if it is less, most likely it will less more. And this expected return is dynamic, which is affected by the market situation. And actually, this expected return, we can segregate it into three groups if needed: rational investor with the certain expected return, risk-averse investor, or even the one that has a behavioral tendency that might, when they see a price drop and when they see a market crash in somewhere, they will just sell. Regardless of the return, they don't consider this anymore. So as a future research, I see it is possible. In our case right now, we just assume that the investor as one group of investor, and we, as long as we are able to replicate between the model and the actual data, we confident, because in system dynamic, we don't call it as a validation, because we cannot really validate something that is further discussion on that, but we are confident to say that our model so far are able to represent the Indonesian market with that index fund.
Okay, efficient market hypothesis is not perfect yet. They perform quite well in the developed markets.
Yes.
So, can you show me, is there any study or findings about the theory of efficient market hypothesis with the emerging markets?
Yeah.
Emerging markets, especially like Indonesia and other small countries, which is the capital is not quite big. So when the big capital from foreigners is going back to their countries, it really influence the performance of the IHSG.
Yeah. So I have read several literature, and I think there are several studies already, a lot, either in highly cited journal or even local journal in Indonesia. Many people try to analyze if Indonesian market is categorized as efficient, semi-efficient, or even not efficient. So there are many discussions.
No
about
conclusion.
No conclusion.
No conclusion.
That's correct. So no conclusion. So there is no clear conclusion of what is the categorization in Indonesia, because in efficient market, even a slight information we get from the company cannot be used for our gain, because the market will immediately reflect the cost of whatever current situation right there. But in Indonesia, it seems like some people can still get some edge based on a certain information, means that the market is not efficient. However, how to prove it is still no conclusion, either efficient, semi-efficient, or not efficient. So the way we do with our research is we did a comparison in terms of our result. So when we see this, let's say one of our research is about the alpha, this economic of scale. We are talking about this economic of scale. We found this in Indonesia like this. In theory, Pan Bisbergen, I think one of the supporters for this value added, in 2016 said, there should be this economies of scale. Fund manager who has more net asset value, they might not be able to generate alpha because they are too big to move, to invest. Let's say if we go to Indonesian stock market, there are some stock that is cheaper as a stock unit, but it gain more. However, a big fund manager cannot invest on those kind of stock because of their net asset value. They can only invest in big company, in blue chip. And as we know, blue chip will just deliver as the market. Because if you look into the LQ45, it's around 60% of the EDX. If you look into ADX 30, is another 40 or 50%. Okay? So big companies will only invest on that. As a personal, yes, I can invest in a certain company as one company and I gain more. But when my net asset value, my asset under management getting trillion, I cannot invest on that company anymore. It's not easy to get in, it's not easy to get out. Okay. So what we did is, we did an evaluation, the comparison, and we look into, yes, in theory, this economies of scale, but in Indonesia, it seems there is a correlation. However, we confirm that this correlation is very low.
Very low.
Very low. Yeah, there is, we jitter here and compare, if we can see, it's very low between alpha and the net asset value, including this one, this data. Yes, it is significant to use as a predictor, alpha as a predictor for value added. And our finding was confirmed by the research in Pakistan, the emerging market, and also a research in the US for the fund that invest in emerging countries. So there are a kind of fund in the US that not only invest in the local US market, but also invest in emerging countries in order to get a good return from the emerging market. We do that in order to compare our result. And one of the challenges as well is finding a good resource. I think this is the most important thing. So we look into the CFA, Analyzed Journal. I think that's reputable in finance. So any data from there, we can compare with that information. Because in Indonesia, when we look into so many local journals with different conclusions, we get confused which to cite or which to follow. Thank you, sir.
Okay, very good. Okay, yeah. Next, I would like to follow up on the Pak Agus questions. Yeah. Like the event studies methodology, the chosen of the 30 months period is interesting. Yet it may show a different result if you choose the starting and the ending point,
Yeah.
or even not on the 30 months.
Yeah.
So if you start from the March 2020 until the September of 2023, if you extend in that period, yeah, the 30 months periods is quite, so when the IHSG is crash, and then it's quite flourish until the end of the 2023.
Yeah.
So the big banks and automotive companies is bullish, yeah. So maybe the performance will be very good. But then in the 2024, the big caps is quite not performing.
Yeah.
So yeah, the chosen of the time period and the length of the time period is not, maybe can be challenging. If you refer to the long-term view, yeah, for the fund managers, is there any study about this? Yeah, is this 30 months enough? The chosen of the months, is there any previous results, findings that may corroborate your research?
We have looked at the previous research about the event study. Unfortunately, specific for portfolio performance, there are so many event studies evaluating the stock performance. So let's say when the asymmetric price limit policy was imposed, what is the impact to, let's say, Bank BRI, or what is the impact to Bank BCA, all those kind of things. There are so many. However, to the portfolio, as portfolio, is very less. So index fund data and equity fund data are available, and we see this as a proxy of the portfolio, because at the end of the day, fund manager for sure will select so many selection based on that. However, we don't know what is the selection behind it. What are the stock affected? But as a general, the market can do. So we look into that literature. Unfortunately, we couldn't find at that time when we drafted our manuscript and we submit to Journal Q2 Scopus. So I was not confident that time with the result and when to submit. And it was maybe around 8 months of waiting until it come back as a review. What interesting for me is the review was good on that result, while I was thinking that this could be not something interesting. And it was revised, get accepted, and then, so I don't know if this is the right approach. However, I just feel the confidence maybe when a journal, when they have the capabilities to view, and this is a Scopus Quarter 2 journal as well, the view of other research associated with it, see this as a value means I was able to deliver a certain value by doing this. This is one. Number two, is it going to be different if it is different time scale? For sure. It will be different when this is different time scale. That's why one of my plan of the future research as well is to evaluate when the asymmetric price limit policy get removed. There was 2 events, which is the first one in July 2024, I think, and the other one is September 2024. It was reduced instead of 7%, it gets reduced to 10%.
Yeah.
And after that, fully symmetric. What you get on the high side is what you get on the lower side. Okay, so when it's happened, the EDX is getting slowed down, so the index is getting downtrend. However, I'm interested to see if this is also affecting that one. Not on this research yet, but I'm seeing that as an opportunity for future research.
Okay, yeah. Meanwhile, maybe you can add some literature discussion or findings. They're talking about the chosen of the periods.
The chosen of the period.
Yes, the length of the periods, because maybe the basic assumption is long term, right?
Yeah.
Is it 30 months is considered long term?
Okay.
Yeah.
Okay. Okay. Sure.
Some people, or maybe 5 years, or maybe 10 years, or even longer, right?
Sure. Sure. So because there are different terms, I believe anything that above 1 year usually considered as long. Sometimes some people consider it as mid-term.
Yeah.
After 5 years only long. Yeah, for sure we can look into that, especially in the context of index fund or long-term investment. Sure.
Yeah, that's why I asked you to see the literature, yeah,
Sure.
the
Thank you very
findings
much.
and the other previous research.
Thank you very much. Thank
Okay.
you, Professor.
Lastly, I can see that you're using the study adopts behavioral theories, prospect theory, adaptive market hypothesis, which is good. Yet I don't see how do you may segment the investors, because usually the fund may categorize the investor based on risk profile or other criteria. Yeah. So could you, I don't know, how do different investor types may behave in this type, or maybe could you incorporating agent-based modeling to enhance, this as to sufficiently incorporated the segment of the investors.
Yeah, that's exactly what I put in the future studies. So in the dissertation future studies, one of it is I'm suggesting to have maybe agent-based modeling. One of it that could be incorporated with this. I think there is a soft system dynamic methodology. I think that's one of the emerging methodology that being used as well to combine between, because I don't want to be in this argument that system dynamic is hard science while soft methodologies is soft science. I think there is another way to view this demarcation between hard and soft science. However, if we look into the social science theory, system dynamics started within the hard area where the functionality of the system dynamic and also the quantitative of the system dynamic plays a role. However, from that point on, I read a research by David Lane in 2021. He said that there are many departures for the system dynamics within the theory of within the social theory, no longer in the functionalism, but it goes to even the socialism, which is in this case system dynamic from qualitative data, talking to people, get all the information, all those kind of things, and put it into the model. Not only from the literature, get the data, put it into the model, and then simulate. So I think this is one of a good approach in the future that can further the information. Even as I said earlier, these areas where the investor decision process can be divided into several group of investors, and we will love to see that characteristic, because at the end of the day, the market is not only habitated by the rational investor, but there is also risk averse, behavioral, and someone who just follow the hot tips. They join the groups, a group of WhatsApp, group of Telegram, and ask, what should I buy in the morning? Okay, and then they just buy and sell it.
Or the influencers.
Yeah, or the influencer, all those kind of things. And this is what really encouraged me to study about the index funds, sir, because in 2020, some people received the hot tips and start doing the trading on the market. But at the end of the day, they end nowhere. Yes, they have to do their own research, but they don't do it. So the best way is open all this information, make the model, all the data. Hopefully it can help people gain more benefit from the market in a rational way, in a very good way. That's it, sir. Thank you.
Yeah, good. I think that's all from me, Mr. Chairman.
Thank you.
Thank you. So next, I would like to ask Dr. Engineer Subiakto MBA. Please, Pak.
Thank you, Mr. Chairman. Pak Nanang,
Yes, sir.
I noticed your voice changed a little bit. So if you like to drink your water, yeah, please do so. Yeah.
Very much.
Saya juga.
Please go ahead.
Yes. Okay. Okay. Firstly, I congratulate you for completing your dissertation, and then yeah, I need to give you my compliment also. Yeah, when I read your manuscript, I think it is very well written. It is nicely moved from one paragraph to other paragraph, meaning that you can express your whatever in your mind systematically. Yeah, thank you. Yeah. Okay, so my first question. This is not actually question, but I need your elaboration probably. Yeah. Okay, it is probably related with your first research question number one. It is regarding the comparison between the actively managed and the passively managed. Yeah, I'm curious. Yeah, in Indonesia is in US we sometimes we know the famous stock picking managerial skill. Yeah. The Peter Lynch of Magellan, even Warren Buffett, Templeton, and things like that. Yeah. The question, or yeah, is there any managerial skill, the outstanding stock picking managerial skill exist in Indonesian stock market or Indonesian fund? Yeah, something like that. So. I think the investor will have no objection to pay the higher expense ratio if they got more return. Yeah, it is the risk averse or the risk averse investor. Yeah. So if you can elaborate what is the difference? Yeah. What will be the difference? The Indonesian managers and then the US managers. Yeah. Please, Pak. Elaborate for me.
Thank you very much, Mr. Dr. Subiakto. This is $1 million question, Pak. and the answer is $10 million. Okay, so this is $1 million question because this is always the question of the investor. Not only today, from before, and also everywhere. Not only here, but also in the state. In principle, people is willing to pay a certain amount for a certain result. That's why the mutual industry is growing. Because instead of me investing in the stock market by myself or putting my investment somewhere, why don't I pay a fund manager with a certain fee in order to get result? The only problem with the mutual fund industry is we don't get on what we get. We get on what we don't pay. Sorry, we don't pay on what we get. But we get on what we don't pay. I think that's the famous firm statement from Jack Bogle. So Jack Bogle said, we get not what we pay, but we get for what we don't pay. Why? Because it is guaranteed that we'll lose money by paying the fund manager. But it is not guaranteed the result. Okay? So the best way is pay as cheap as possible, don't pay much them, in order for the result to be make sense. Okay. Yes, there are a very big name in the investment world, like Warren Buffett or Ray Dalio, all those guys who invest in stock market in case of Warren Buffett, but maybe some other is in the other type of securities. So in Indonesia, the only problem is the data is not public. Yes, I heard there is a guy, let's say Mr. Lee Kehong or anyone, who were famously said that, who were acknowledged by many people that he is a good investor. However, we as a scientist, we don't see the data. When he started, what is his net asset value? How much did he spend on the cost in order to get the return that he got? What are the stock selection? We don't get that information. Okay. So we as a scientist, maybe as an influencer or as an investor, we can choose, we can decide, yes, I want to follow this guy, I want to follow that guy. But from scientific point of view, without that information, we cannot validate if he is really true, the person able to read the market and invest in a good way. And not only him, let's say, there are several other influencers that says, look, I invest on this and I got lots of money. I invest on that, I got lots of money. But it turns out at the end, it's become a scam. Okay. So all this, if we go back to the data, we see that, yes, there are lots of mutual fund manager, equity fund in this case, earn alpha, earn a value added. However, if we see from the quartile, I think in the short description of the dissertation, I also put the table highlighting the percentile of the fund manager that get the value added and not get the value added. It's concentrated on the left side, which is 1 percentile, it doesn't get the value added. 1 percentile doesn't get, has value added, but in general, it's negative. So if we don't know that this company is no longer able, why we have to pay them much? So let's pay them less. At the minimum, we get the return of the market. And if we see the trend of EDX as the market, if there is any index fund that were able to give the return of the market, it could be sufficient for us. 10% or 8% per year is a good enough. And we don't have headache just to see the market all the time. For the investor, if we see the ratio between the total asset of mutual fund to GDP is very low in case of Indonesia, if we are working on this mutual fund with the pension industry, let's say it could be moving to a bigger direction. And we are no longer about taking advice from people on hot tips, on social media, all those kind of things, but move to a more academic and theoretical support, theory support investment. Something like that.
Yeah, thank you. Okay, the first one is regarding the skills, the managerial skills. My second question is regarding, I think you mentioned about the agency theory, the agent and principal alignment, the agent and principal alignment. Here, the fund managers is in the crossroad whether to satisfy the shareholders of the fund company or to satisfy the investor. I think the theory is valid for Indonesia and also for US, right? That's influencing the same industry. But why the result is different, the expense. I mean, the fund expense ratio, as you mentioned also, Vanguard is only charging 0.12, 0.14. Yes. In Indonesia, 2% above, something like that. It's a big difference because it bites the index performance. Taking 2% of the return is very significant. Can you explain? My thought is, it is probably something related with the size of the fund. So if the size, the asset under management probably, the AUM, if the size of the fund is small, then the fund still need to pay the managers nicely, and then it is taking a big portion of the asset under management. If that is the case, do you input this size or the asset under management on your model, on your endogenous factors, something like that? If yes, explain. If no, explain.
Okay.
Okay.
Thank you very much. Okay, thank you very much, Dr. Subiakto. So, as you said, as you clearly emphasized, that the fund manager is in the crossroad. And not only here, it's also everywhere, including the one in the state. That's why Jack Bogle is advising on the index fund as a way to resolve this issue. Because in this case, let's say we have this model, we have this causal loop diagram on the right. So the fund manager job is to satisfy their shareholder. Their shareholder is the shareholder of the company of that fund. Okay. However, they also sign the fiduciary duty, supposed to be. Fiduciary duty means that they should act on the best interest of the investor. Okay. But having this structure is not possible because they have to choose. Either satisfy the company or satisfy the contractor. If they satisfy the investor. If they satisfy the investor, they cannot generate profit good enough for the shareholder. Okay. This case will only resolve if the shareholder is the fund itself, is the investor. When the shareholder is the fund itself, is the investor, whatever profit generated by the fund manager will be returned to the investor in any other way. The first one is either as a dividend, the company share the dividend as a gain distribution, and it goes to adding the net asset value, and it goes to investor at the end of the day. The second option, which is the first loop number 6, reinforcing. The more profit they generate, the more dividend they share with the shareholder, the more asset value get increased. This is the engine of growth for the fund. So this is exactly as you said. The cost might be minimal. The cost is in the second one, but at the end of the day, the net asset value will be bigger. The second one is the expense ratio. When they have the profit, share as a company profit, it can be either used as a dividend or reduce the cost. Because if we are talking about the index fund, what are the costs of the index fund? We are not talking about the research of the companies. We are not talking a very big marketing. We are not talking about all those expenses, big one, most probably related to the trading engine. How can we trade efficiently in order to buy 30 stock at a time in order to equate the proportion of that to the index? And I think in Indonesia, we are talking about 45 company for LQ45. We are talking about 100 for Compass 100. Or maybe we are talking about 30 for the EDX. In the US, we are talking about 500 companies, S&P 500. If they can execute a trade for 500 companies in an efficient way for 45 companies or 100 companies, we should be able to do so. However, that technology is associated with the fund size. If the fund size at the very beginning, it may be hard to acquire the technology, let's say. The trading could be manual, quote unquote. But if the fund is getting higher, then the technology could be acquired and then get efficient and the cost get efficient. When the cost get efficient, the fund asset is getting higher. This is another reinforcing or the growth engine. So I agree 100% with you that this process will, this structure will enable the fund to grow, agent and principal problem get solved, the fund manager is no longer in the crossroad, he can fully satisfy his shareholder as his duty to his company, he can also fully satisfy the investor, taking oath to his fiduciary duty. So this is how can be done. The question now is, can this be done in Indonesia? This goes to the regulatory framework. Is fund allowed to own a company that's not in the stock market? Because this fund, some fund might not be in the stock market. Some of fund manager are in the stock market. So if this can be done, this is a breakthrough and move forward. Yes, even though the Vanguard is, let's say, 0.12% on the expense ratio, however, the equity fund in the US still is so big, around 1.5 to 1.3 to 1.5%. So that's why the shifting at the beginning, we see the shifting. This is where, this is the shifting. This is where investor start looking into, oh, there is a better way for us to invest. I had discussion with our co-promoter earlier at the beginning of the research. When we see this data, are we sure that this number, the 2.5 trillion that out from the equity fund goes to that? We can't be so sure. We don't have the data and we don't have the research. However, the number is coincidentally the same. 2.5 trillion out, 2.6 trillion in. So most probably there is a shifting in terms of the preference. Something like that, sir.
Yeah, thank you. You handle every question nicely, yeah. Very good. So I have a couple other questions, but I pick only one last question for you. It is regarding the opinion, yeah. I'm asking your opinion, yeah. Do you think that the index funds still have future in Indonesia? Yeah, considering, you know, the compounded annual return of the IHSG, yeah, in the last 10 years is also not satisfactory, yeah. So a lot of, you know, the capital flight also, and even some analysts, some investor convert the performance of Indonesian index fund into US dollar, yeah, convert it into US dollar, even it is far, you know, worse, yeah. So it probably trigger the capital flight and things like that. And then what else, yeah. Yeah, that's basically, I need your opinion. Even with lately there is an AI-driven funds, yeah. So if I don't know the result, but if the result is, you know, with the help of the AI, then the performance of the fund is getting better, then it will be much more challenging also for the index fund maybe. Yeah, I don't know. I need your opinion here.
Thank you very much, Dr. Subiakto. I remember in 2018, Eugene Fama, the efficient market hypothesis, he's the Nobel laureate, received because of the efficient market hypothesis, was interviewed, and he was asked about the emerging of the new technology. Let's say using AI, that now AI can, in my dissertation document, there is a comparison of, there is research comparing between the index fund that was developed by AI fully and index fund that's picked by the fund manager. So a fund manager could, do an index fund, and then AI could also do the index fund, and the result was almost comparable. Okay. When he was asked about this emerging situation, people was asked, do you think the efficient market hypothesis is still intact? Do you might want to change your mind? Because he already, in terms of the capital asset pricing model, he already proposed several revisions to his process, starting from 3 factor to 5 factor. Is there any additional factor do you want to add? Maybe AI factor accounted in the CFM. His response is, for me, is something that's shocking, because he said, the way I see this is I become much more believe that efficient market hypothesis will still be there for more year, for a very long year. Why? Because all those people competing, even the engine is competing in the market, in the fraction, not only day, in the fraction of second, is even more make the market more efficient. That his reasoning is even more make the market more efficient. Because before was between me, let's say, and one of the invitee competing in the market, there are more CFA now in Indonesia. Before we don't have CFA, less CFA. For a certain company, we don't have people who analyze that company, only for big company. Now even for small company, there is CFA analyzing that company. The number of these people acquiring CFA is even a good sign that people is competing even harder in the market to get an edge, to get the return. So according to him, I even more believe that efficient market hypothesis will still be there. I don't want to put a pressure that only efficient market hypothesis. For sure, there is a behavioral science, adaptive market hypothesis, all those kind of things. This is just Eugene Pama being asked about it. So when you ask me what is my opinion about the Indonesian stock market, the way I see it, the stock market will still be here. Either tomorrow, either next month, either next year. However, the performance for sure will up and down. Actually, the only thing for sure in the market is the stock to go to the side, to the right. Not going up, not going below, right? This is one of the joke that we have within the group. So where is the stock market going tomorrow? Is it up or down? And the answer is going to the right. That's the only answer, okay? Because it will still moving. So the stock market will still be there. Yes, there are dynamics. I think one of it right now, if you can see here, the percentage of the mutual fund is heavily dominated by capital protected fund. People, when they put the investment, they want their capital to be protected. I don't want to lose my money. Give me my money back. And if we see the trend of the SBSN, Sukuk, or even obligation of Indonesia, the trend is getting up. Even right now, there is an issue. I just read the news the other day. They said that the banking banking corporation right now is struggling to get the third-party deposit in their account because the money goes to the obligation to sukuk, all those kind of things. There is a dynamic that people want their money to be protected. But index fund is also protecting their money, quote unquote, risk-wise, risk get reduced instead of the stock, but maybe the understanding or the trend is no longer there. So the way I see it, it might still be there, might continue, especially if it coupled with the pension fund. Okay. But the things that comes to the process is risk, managing the risk. And I think that's also no coincidence between 2000 to 2010, and then 2010 to 2020. The Financial Analyst Journal, the word occurring most of the time in this journal is risk. That's the number one. So at this time, maybe managing the risk, lower the risk, get the result is much better instead of trying to chase a higher return while the risk is not managed. Thank you.
Okay, yeah, thank you for your response, Pak Nanang. I think that's all. I'm returning the session to Mr. Chairman.
Thank you.
Thank you, Pak Subi. So, yeah, next we will ask the promoters, from promoters. Oktova Yuda Sudrajat, ST, MSM, PhD. Please.
Okay, thank you, Chair, for the opportunity. First of all, I would like to congratulate. I'm happy that Mr. Nanang stand there to defend her dissertation after some discussions in the earlier stage. And right now, you are there and trying to explain and also defend what you have in your mind years ago. And the topics that you already taken are also quite interesting. I mean that most of the investor, that's the questions of some investors and also regulators, and the other things that some of the data perhaps is not easy to collect. So you take that hard way to do this research. So first, I would like to congratulate you. And anyway, I have some questions as well. While the previous examiner perhaps already asked about your theory and also methodology, here's I just curious about, because you already come up with some models, particularly using the system dynamics. Yet I didn't see the operationalizations or operational strategic that you can propose, because you using system dynamic what in my mind that you can make like some scenario that then you can come up with some decision how to what extent, yeah, for example, for fund managers, for example, at what asset under management, for example, 100 billions, and at what expense ratio, because you see, yeah, you come up with the suggestion that enhancing fund efficiency, improving survivability, and also optimizing the structures, cost structures. But how you can do more, yeah, I mean, or perhaps you can elaborate more, yeah, whether your simulations can come up with some practical or technical action, yeah. So here that, for example, to maintain, yeah, the inflow of the cash inflow, for example, yeah, atau net inflow, positive net inflow, at what expense ratio that must be kept by the fund manager, yeah, for example, under 8% or under 0.8% or something, or under some percent, to what level of under asset management. So you have some like tiers, yeah, for the assets. I just curious whether the simulation can go into that scenario.
Thank you, Mr. Yuda, PhD. So the model that was developed is intentionally, if we look into this, is intentionally, for the practical point of view, is to be owned by the fund manager. So intentionally, so the problem owner, if we see at the very corner on the upper top right there, is to be owned by the fund manager. The use for it is simulation. Okay. So when even though the fund manager is not quote unquote, for sure they will have their own simulation right now on how to, when they make a decision, how much cash should they keep, how much percentage of the cash they should keep, how much should be in the portfolio, how much is the how much these expenses, all those kind of things. Most probably they have the model on their own. However, with this is we are giving them a tool to simulate beforehand. So when they choose to increase the cost allocation of this much, I think maybe it's easier to show. A second. I have the other model. I have the stock and flow diagram. This is in the short dissertation as well. So this is the stock and flow diagram. So this number can be put any initial number. So how much cash they have, how much portfolio securities they have, or how much the NAV value they have, how much they should estimate for the cash to be allocated, how much percentage, how much the cost, and then these, when they simulate it, they can see what would be the impact on the inflow, what would be the impact on the performance, what would be the impact on the profit, all those kind of things. So practically, this will be much beneficial if it is owned by the fund manager. However, I did my approach to the fund manager several times. Unfortunately, they are not open with the discussion in terms of exposing their strategy, because at the end of the day, it's something that they get an edge out of it. So I bring this into the open right now as from the literature and the finding that we have as part of the educating of that process. So hopefully by doing this, and if someone reach out as a project manager, practically it can be applied as a simulation before they take any decision.
Yeah.
That's the point.
Okay, thank you. So with that, in that way, perhaps did you already try it? Yeah, means based on your just doing like hypothetical analysis, yeah, based on some data that perhaps even though you cannot use the real data from the fund manager, but if you try to simulate based on the assumption that you made to all the input variables, yeah, perhaps then you can just say it, yeah, if it is hypothetical, what is the effect if I did, increase the expense ratio to the asset under management, or if my asset under management hires, what is the expense ratio there? Because usually it's a trade-off, correct? For the retail company, but if for the institutionals, I will ask later on after the second one. But for the institutional, perhaps it's not concerned to the expense ratio, but for the retail, perhaps expense ratios will be also significant for them, sensitive.
Yes.
Yeah. Did you already try it to
Yes.
make a hypothetical, and what's the result? Perhaps you can share to us.
Yes. So this is the first step in the modeling, which is when we build the confidence. Out of the model, we compare between the data and the simulation. When we get a good confidence, in this case, we see a good fit, R square is around 0.8, we got the expected parameters. Let's say in this case, we already get how much is the cash allocation, how much is the security allocation, how much is the cost, how much is the expectation, we call it as a how much coverage, amount of cash coverage the fund manager allocate. This number associated with what you say as a dummy. Okay, so we got those dummy. So I did a simulation based on that dummy. If we reduce the cost, which is the next one, unfortunately the graph is not ready available in the presentation here. If I did a simulation that the cost put it into the profit, put it back into the company, what will happen? That's why it gets increased. So that is the part of the scenario analysis that can be done. Maybe this presentation does not present that. However, that was done as part of the exercise and can easily be reported into the dissertation.
Okay, thank you. Because I think that's the interesting part in your simulation.
Yes.
But you keep it, even though I know because it's not real data, but you can just use it using dummy variables to capture some. I mean that dummy is not mean that it's just you taken, but I think
it's already verified.
You verified from some sources or something. So not only the behavioral times of to make that this is valid, your model is valid, it's the validations apart, but what is the decision that you made based on the model that will be interesting, even though it's using a dummy. It is fine, So I like to suggest you, to put also the dummy simulations,
Thank you. Will do.
More picture, about the result if we do some adjustment in the model.
Sure.
Okay, thank you. That's the first one. The second one is related to the first part that I mentioned, because you make aggregation between retail and also corporate. I don't know. I just want to confirm first, whether it is you made a differentiation between retail investors and also institutional investor, or you just put it all together.
For now, in this model, we put it together as one group of investor, because we don't have the data. Unfortunately, we try to get that information. So let's say, if I look into a fund, how much is the institutional investor in that fund, and how much is the retail? Those data, unfortunately,
that's confidential for the.
Yes,
company,
I have reached out.
Cannot be published anywhere. That's why a dummy is still fine. So my suggestion is also, it's better to put different part between the retail and also for institutional investor, because they behave differently.
Yes.
For investor, retail you focus for expense, while for the institutional, perhaps they try to get the alpha trackings or how make the overlay strategy. So means that not only focusing on the one part, that's make it different strategy that perhaps will be applied to them. Okay, that's my second suggestions. And last, I didn't see in your dissertation is recommendation to the regulators or to investor, I think it's better, yeah. Or do you have any explanations for that?
Yes, there is a section in the dissertation, but not in the presentation. Something lesson learned. Actually, it was triggered by one of the questions from the examiner. What could be the lesson learned that can be implemented in Indonesia in terms of regulation, all those kind of things from the index fund industry outside? So I mentioned about the suggestion in terms of the regulation. One of it is to accommodate. It is possible for the fund to allocate in the company shareholder in order to accommodate this structure. Number two is the transparent and an easy to digest information. Let's say the fund fact sheet right now between one fund manager to another fund manager is bigly differentiated. So if the regulator can work out on this simple information, it could help. Number three is also about the synergization between the mutual fund and the pension fund industry, and with the pension industry, because one of the driver of the index fund growth in the state, in the US, is one of it is 401k, which is associated with the pension. And there is a portion in there that one of the investments, some of it is self-directed investment. So the investor are able to choose from the list of investing companies or investing asset in order to choose. The same like when I was working outside right now, at the beginning when I got the paper from the company, I got the option to choose which company do you want to invest as part of your retirement plan. So all this can be part of it.
Yeah, perhaps I got the not the latest document yet, but please. So I mean that your suggestion will be specific, for example, for regulators, for the fund managers, for the retail investors. So means that it will be give them some insight, when they are doing some actions.
Sure, we can add that information. Thank you very much, Dr. Yuda.
Okay, I think that's all from me. Chair, thank you for the opportunity.
Okay, thank you. Pak Oktova Yuda Strajat. So next, the last question from the chief promoters, Pak Professor Dr. Sudarso. Please, Pak.
Okay, thank you, Mr. Chairman. Because so many questions has been asked to you, I just want to know about your result from your simulation, your findings. From your study, what contribution actually do you make to the market stakeholder about the impact of the asymmetric price cap policy in the stock market on the stock portfolio returns? Firstly, okay.
Thank you, Prof. Sudarso, for the question. So for the asymmetric price limit policy, so for the asymmetric price limit policy, so from the asymmetric price limit policy, we clearly said the contribution in our paper before, that the contribution is we give overview. And it could be a point for the policymaker when they are implementing the asymmetric price limit policy, that those policy proven from the data are able to reduce volatility, and even where a stock portfolio in this case was able to generate a better return. That's on one side. However, from the market point of view, those results is still below the expected return, which indicating by the average abnormal, cumulative average abnormal return that is in the negative territory. So that's why the suggestion is about the index fund. For the research as a whole, as a model, the contribution that we do, first one in the academic areas, which is in theory, we propose something new. Before, there was never have this model using the system dynamics in terms of index fund. Now this has become a formal model. It can be tested, it can be checked, it can be verified, it can be refutable on the other side. Number two, we bring to light the data from Indonesia, because if we are talking about risk diversification, about investment as well, the best diversification is not only in the developed country, but they also, including the, if we are asking about Markowitz, he's suggesting also invest in other countries as well, One of it is the emerging market like Indonesia, because the growth might be higher than the developed market. So bringing to light the data from Indonesia related to the equity fund, related to the index fund, it might enhance the view from investor who's willing to invest in Indonesia. The third one is for the practical application, from the practical point of view. This system dynamic model that we are proposing is not something that is complex model. I believe in the parsimony. So if we are talking about the theory, the best theory is the simplest theory. The best theory is the simplest theory. So in economic, complexity comes with a cost. If you want to be more complex, come with a cost. However, this model supposed to be something that can be, I can make all the formula available publicly, so people can take that information, and in this case, fund manager could develop the model, enhance and use this simulation before they make any decision. Because at the end of the day, I think I take the quote from Homer in 2001, that even a simplest model could give benefit for learning and for doing the decision making. So maybe that's the contribution in general, Prof. Sudarso.
Sorry. Actually, I would like to know about the question previously from Pak Subiakto that talking about the ETF, talking about the index fund and so on and so forth, the cost is quite high.
Yeah.
And using your model, is it possible to reducing the cost? So then more of the investor, especially I want and I have the dream actually that the young generation also starting to invest in the capital market, yeah, because this fund is become. What is your about the fee?
Yes. So it is possible if we use this structure and the model that we simulated, it is possible for the fund manager to deliver a lower cost. However, for sure, this cost has to be, I don't know how possible in terms of the regulation to implement this right away, okay, in terms of the regulatory environment of Indonesia, but model-wise, based on our simulation and the output, it is possible to reduce the cost. Because if we are talking about the index fund, there is not much cost associated with it. It should be capped at the minimum as much as possible. However, could be the challenge is the net asset value. If at the beginning it's still low, cost might be higher. But if it is a fixed cost, the more the NAV goes up, the lower the percentage of the cost. Okay, so the most important thing I think the investor want to see is the trend, Professor. So the trend means the fund manager should be more transparent with their cost structure. That look, this is the cost that we charge you right now, but this cost could be lower once this goes up. And I think that could also offer transparency, and people will benefit from that.
And last question. Actually, the previous discussion talking about the impact of the COVID-19 yes. on the stock market volatility and the performance has been extensively studied in several recent studies. However, most of the result still focus on the effect of the pandemic on individual stock or overall market behavior. Yeah. This leaves a gap for research that discuss the impact of specific policies in mitigating the impact of the pandemic and stock portfolio, especially on the long-term impact such as policies. Yeah. Are you interested in conducting the above research, especially related to the policy-driven dynamic that affect the stock portfolio?
Yes. Yes, that's exactly what we did. And really appreciate your question, Professor Sudarso. That's exactly what we did. Because if we are looking into the portfolio, at the end of the day, anyone who ever invested in the market will never buy one stock only. They will buy at the minimum 1, 2, 3, 4, 5, which is comprising of portfolio. So this number of portfolio, the impact of the COVID-19, the impact of regulation, the impact of that, the study on the impact, effect of the portfolio is very less. I think because of the data of the portfolio is not available. However, with this equity fund, with the index fund, the data is become available and it's publicly available on the monthly basis from the OJK. Thank you, Mr. Agus. I think that's OJK did a great job on that. And we did that research on that and we found out that the impact is positive in terms of the policy, asymmetric price limit policy. So the asymmetric price limit policy was able to reduce the volatility, reduce the risk, and fund manager was able to deliver a better result on that. Yes, I really interested on that.
Okay, thank you.
Thank you very much.
Okay, so Alhamdulillah. So ladies and gentlemen, we just finished the first session of dissertation defense, and then I will ask your patience to give opportunity to Graduate School of Commission to conduct evaluation meeting. Then I will suspend this session for about 30 minutes.
Thank you very much.